Bond values are at an all-time high. There's never been a better time in the last 50 years to own bonds or bond mutual funds. So why are so many experts like billionaire investor Ray Dalio saying you'd be pretty crazy to hold bonds right now? Well, it's because they know that bond values and interest rates are inversely related, meaning if interest rates rise, bond values will fall like a teeter-totter. It's a law of physics in the investment world. And in March of this year, the Federal Reserve lowered interest rates to near zero, and the Fed reconfirmed their commitment to leave rates there in June. Now, that's as low as interest rates have been not only in the last 50 years, but that's as low as interest rates have been in the last 5,000 years. Interest rates will never be lower, which means bond values are as high as they've ever been and as high as they will ever be. Bond values will never be higher. Interest rates can only go one direction, up, which means bond values can only go one direction, down, like the teeter-totter. That's why the investment experts are steering clear of bonds and bond mutual funds. But what if you already own bonds or bond mutual funds? Well, in that case, you couldn't be happier. Bonds are worth more now than they've ever been or ever will be. Now, you know the saying, buy low and sell high. Normally, the problem is that we don't know the high or low until after the fact. But this is one of those once-in-a-lifetime moments when we can be certain we're at the absolute high. We can confidently get out now at the absolute high, maximizing our profits and avoiding the inevitable downturn. Or I suppose we could do nothing and wait for bond values to crash back down to earth. But it really is that simple. You can get out now and make money, or you can get out then and hopefully break even. But if you choose to hang on and wait until then, there's a good chance that you'll be trying to sell when everyone else is trying to get out as well. It's obviously a no-brainer to get out of your bonds and bond mutual funds now. It's just that, then what? What do you do with your newfound money? I mean, you still want it to grow, right? Well, consider capital protected investments. They've been around since 1973. They've been used by Fortune 500 companies in Wall Street for decades, and recent changes have made them accessible to Main Street investors. Investopedia says that capital protected investment products not only provide the upward profit potential, they also guarantee the protection of your capital investment. A CPI product claiming 100% capital protection assures that investing $100 will at least allow you to get back the same amount of $100 after the investment period. If the product generates positive returns, say plus 15%, you get the positive return of $115. The CPI concept can give you a safer way to earn the equivalent of 5 years' worth of bond interest in a single year. And your principal is guaranteed whether interest rates go up or down. To learn about these kinds of investments and get any questions you have answered, just click the Schedule a Call button on the bottom of this email. A calendar will pop up where you can select a day and time for a quick 15 to 20-minute phone call. On that call, we'll walk you through how to determine the current value of your bond and bond mutual funds, and we'll walk you through the different types of capital protected investments that are available to you. It's free, it's simple, and it's easy to get your questions answered. Just click the Schedule a Call button at the bottom of this email and schedule your 15-minute call.